Tell us why you feel that this current environment of European outperformance, and let's throw China in as well, and US underperformance is coming to an end.
Because I don't think it was fundamentally driven. I think that when you look at the fundamentals, we still have really only one solid choice here, and that is large cap US growth equity. I understand that when we had a bit of uncertainty, we still have quite a bit of uncertainty, challenges are mounting, that people want to sell the only thing that they really own and that they have profit in, and that maybe they're going to try to rebalance a bit with what they're very underweight in. So institutional investors had a massive underweight in European equities, massive underweight in Chinese equities, and a massive overweight in US equities. So a little bit of rebalance makes sense when you're not quite sure what's going to happen. But I think as we get through this uncertain period, that actually we will return to fundamentals. And it's really the high profitability, the strong earnings, the low need for borrowing, the low leverage, et cetera, that you get from U.S. equities that is going to provide returns going forward. The underweight in Europe is closed. That's gone. That's driven so much of that performance. Institutions actually have a bit of an overweight in Europe now. I don't think anybody is saying growth is looking better anywhere, actually. It's all based on some expectation that things will get better in the future without any specifics to it.
But it's driven by valuation, isn't it, Dan? I'm sure you'll agree. And aren't valuations looking compelling still in Europe and China?
Not really. I think that valuations, if you look on a longer term, let's say cyclically adjusted price to earnings, then yes, they do. But that's not the stuff that investors are buying. What they're buying is the banks. They're buying the defense companies. That's what's driving so much of it. And on that sense, valuations have already risen quite a bit. It's not this kind of broad buying of Europe. So valuations were cheap for a reason. Nobody is really pushing growth estimates higher. Whereas if it's tariffs that are the reason that people think growth is going to take a hit, well, shouldn't they be reducing their earnings in U.S. corporates, or at least taking U.S. growth expectations down from an economist point of view? And no one's doing any of those things. So I think really, yes, there is a challenge to valuations in the U.S., and I am worried about that. It's just that what we're seeing now is not that. We would need to see a pretty big change in the overall credit liquidity environment for these valuation fears to take hold. Not saying they can't. It's just we're not seeing it yet.
Well, Dan, you could also make a sort of a counter argument that, in value terms, the U.S. is looking a lot better than it has before, right? You've got the S&P and the NASDAQ in correction. Folks are watching for the Dow transports to go the same way. Small caps, the SOX Semiconductor Index, the Mag 7 as well. The values are looking a lot better than not so long ago. I think the question is going forward whether earnings can keep up. And, I'm wondering whether or not, is there any way to sort of figure out, have you figured out whether or not these stocks have priced in the worst possible outcome from tariffs, that is reciprocal tariffs, and how high they could go?
Yeah, look, I think it's two different things. So the question is, let's take a step back to the first part of your question. And I think if we went back 4, 5, 6 months, everyone was saying, if only the tech adjacent, the runners in the U.S. would pull back a little bit, I would have this opportunity to get in. And of course, it never works like that, right? When you get a pullback, there's fear, there's a reason. But I don't think it's the tariffs that are the cause of the valuation concern. I think tariffs really have an impact on foreign exchange in a flexible foreign exchange world where you don't have a gold standard, where you really can can see the flexibility there, because the amount of the tariffs isn't actually that much, as far as we know so far. Look, we don't know a lot still. A lot can change from Trump's plan in a few weeks. However, think about the $200 to $400 billion that's expected from tariffs, the U.S. has a trillion plus dollars of credit card debt at 22% interest. We're not thinking about that the same way, even though that would take an even greater hit on the consumer since it's recurring. I just don't see the tariffs as the hit to equities and earnings, weighted earnings or aggregate earnings in that sense. The valuation side would come from a much more hawkish Fed in a banking system that didn't want to grow the asset side of its balance sheet. And we just saw an overall reduction in money financing all of this. That is what I'm really nervous about. I just don't see it yet. I see a kind of neutral Fed and a banking system that's actually starting to pick up on credit expansion once again.